Unfortunately, it seems like we haven't really learned a lesson because in Canada, we're set up for the exact same thing to happen, right? Where we just saw a bunch of people take on rates in 21, 22 at record low rates. And in the next 2 years, 2/3, I think, of mortgages in Canada have to renew. And they're all going to have to renew at least a 50% increase in capital costs, if not like 100% increase in capital costs. And so this is going to have a huge drain on our economy, right?
Yeah.
And I think the outcome is going to look, I'm reluctant to say as bad as the global financial crisis, but I think the outcome is going to look pretty bad.
What's up, guys? Welcome to the Wolf of Young Street podcast. This week, my guest is Dan Foch. He's a real estate broker licensed with Rare Real Estate. He's a member of the Canadian Real Estate Association, Toronto Real Estate Board, and the Ontario Real Estate Association. Plus, he's got his own podcast, the Canadian Real Estate Investor, which I listen to every week. So you guys could go check that out. But welcome to the show, Dan.
Thanks for having me. Pleasure to be here.
I was just to start with here, I'm curious about your journey. I know you've been at this 15 years, so you're a vet. And yeah, I'm curious about what that journey was to this point in your career.
Yeah, it's a good question. I think a lot of people in the real estate profession want to end up, like, I think most realtors don't love the fact that they're realtors, right? So I think a lot of people want to end up in kind of the commercial space. Or like doing more complex transactions, representing investors. I actually started in that world. So I started with, I worked in research at commercial brokerage in the city of Toronto, CBRE, which is, I guess, the biggest commercial real estate brokerage in the world. And I didn't love it. So, I had a hard time like imagining myself in that environment. I mean, I really liked the team that I worked with. I liked the asset class, but it just, the environment wasn't exactly what I was looking for. It was kind of too employee and 9 to 5-ish. Yeah. And I wanted to sort of have flexibility over my own schedule and a bit more of an entrepreneurial. So I started working with a family business, my family business, when I finished university. I did an undergrad BCom in real estate and housing, and started working with a family business. My mom sold residential property. My dad sold commercial land, typically like large land to developers of subdivisions. And I kind of just started picking up slack in between their books of business. So I sold a lot of houses, sold a lot of land, and gradually progressed. I think the beginning of COVID, like most of my investor clients just kind of left the market because things were like the returns didn't make any sense anymore. Yeah. And so a lot of the analysis work I was doing, I was realizing that like this housing crisis was forming, and I started sharing a lot more of that analysis work publicly on social media, on Instagram, et cetera, and kind of really evolved more into an analyst role. I'm reluctant to use the word economist because I'm not qualified to be. Well, I'm not qualified to be an economist, but also I feel like they have a similar reputation to meteorologists these days, where they're like one of the few people who gets paid reasonably well to be wrong all the time. So. Yeah. So, I mean, that's what now I honestly, I mean, my primary time is spent making content, right? So I write, analytical blogs, I make YouTube videos, I make shorts on Instagram and TikTok, and we host Canada's #1 real estate podcast, and fortunate enough to have revenue from all of those streams. So, it's been great. That's kind of how I ended up here. I hope that it answers your question.
Yeah. So for people looking to get into becoming real estate brokers, maybe we should go there. In terms of the approach from the education standpoint, or what kind of education could they get to help them on their journey, or what kind of preparation do you have to do to become a real estate broker?
Yeah, I would say like to actually get your like realtor license is not a lot of work. Like you can, I think, varies on a province by province basis. Your audience mostly Canada, or is it kind of all over the world?
It is mostly Canada, but okay. I'm hoping
it
does become a worldwide thing. We'll see.
Yeah, I can see it happening. Yeah, I think, even in the U.S. and around the world, I don't like it's not a huge commitment it's not a huge barrier to entry to get your real estate license. So, in Ontario, I think it's like a 6-month college course that you can do mostly online with a couple of in-person modules and exams. And then you would write a test, and you would get your real estate license, and that would allow you to transact properties. You would have to be registered with a brokerage and pay. I think the course is like maybe 6,000, and then to become actually registered is like 2,000 and some other expenses. So, let's say maybe 10K really, which is like your total barrier to entry. So like, if you think about the earnings potential, like your average, it's not really that.
Yeah.
Yeah. I mean, like, if you were to put it, even if you're not giving a real estate professional a ton of credit, and you're saying, okay, they're making 100K a year, what other profession can you make 100K a year that you can pay $10,000 and 6-month barrier to entry? I don't think it exists, right? Maybe mortgage professional would be the only other one.
Yeah.
Yeah.
Okay. So I'm curious about like the step-by-step here. If someone say they want to buy a house, in that, and they've decided, okay, this is the or maybe they haven't decided. I want you to walk us through that process from, okay, I've got my money or whatever, I've got some money, and I would like to invest in real estate. How does that go?
Yeah. So, I mean, the first step for anybody is to actually run some version of a discounted cash flow analysis to determine whether or not it is actually economically sensible to invest in real estate or to buy their primary residence, right?
Right.
Like what return could you earn on that capital, that down payment that you're describing in just the S&P 500, right? Like just your indexes. Maybe what is the S&P return over past 10 years? 10%, like 8 to 10%. Yeah, 10%.
Yeah.
And so you let's say you got $200,000 down payment at 10%, plus, you run the calculation on your mortgage payment, monthly mortgage payment, taxes, maintenance, insurance, all of these costs of ownership. What percentage of your mortgage payment is interest, and what percentage of your mortgage payment is principal? How much money are you really gonna make? What do you expect the property value to go up by? I think the average historic is like 7% per year. Right. And it'll spit out a value, and 9 times out of 10, it usually was more economically sensible to invest in the S&P 500 index, right?
Oh, wow.
Yeah. And so that would be the first question that somebody would ask. I'll get to the next steps, but I think the big thing is for a lot of people, especially when you're buying your house, like you're owning your primary residence, is most Canadians need a savings vehicle, right? Like, and that's really the primary function of real estate for the average Canadian, is that and so, so it forces them to save money. Once you've decided if you want to invest in real estate, and I think if we're just going to say investing, like let's set aside the primary residence. If we're just going to say, okay, when does it become a good idea economically to invest in real estate, then you would just run it kind of in the same scenario, and you'd say, what return do I need to get to outperform the S&P 500 index? Because if you can do the S&P and not have to manage a property or whatever, then
or tenants
yeah, exactly. Yeah, you don't have to worry about landlord and tenant law. You don't have to worry about the something happening to the property, managing a physical asset, etc. So then the outcome of this discounted cash flow analysis, or some sort of cost benefit analysis, is to say, okay, yeah, I'm only going to allow myself to invest in real estate if it gives me a return greater than what I can get risk-free or medium risk. I would say same risk profile. If you're, the S&P is probably the same risk profile as real estate. And then you have to go find an investment that would check that box. And that's where things get hard. So then you start looking around and kind of going through the in-depth process of finding a real estate investment.
Right. So I wanted to get into the mortgage process and how that kind of plays out as well.
Sure. Yeah. So mortgages are not super complex. I mean, basically the bank's going to want to know that you can service the debt, you or the investment can service the debt. So they do this using what's called the debt service coverage ratio. So on a personal basis, that's a GDS or TDS, gross debt service or total debt service. And those are capped at percentages of your income, although there are exemptions that are pretty common, to be honest. But I think it's 39% for GDS and 42% for TDS. I'll confirm that. But so that basically means you can only spend 39% of your income on gross debt service on debt service for the property that you're going to be buying.
Right.
That, and like okay, your monthly income's $10K, you can spend $3,900 on a mortgage payment. And then on an investment property, they use something called a debt service coverage ratio, or DSCR. And that basically is a calculation which is the monthly income of the property divided by the monthly mortgage payment. And they would be expecting the result of that ratio to be well, it varies by lender, but typically your average A lender is going to be looking for like a 1.2, 1.25 debt service coverage ratio. And so that would mean that your property would have to be 25% cash flow positive, basically.
Okay. And when you kind of bring it down to the concept of like down payments and stuff like that, right? There's a decision to be made there where beyond lower than a certain threshold, there's a possibility of being basically in the red, negative. You have negative equity in the property lower than a certain threshold of a down payment. And I wanted you to, because that's a concept a lot of people don't grasp, and I'd like you to kind of expand on that for us.
Sure, yeah. So, I mean, in that example, if you buy a property as a first-time home buyer or owner-occupied buyer, you can purchase a property with a 95% loan-to-value mortgage. So that means that you can you can buy with just a 5% down payment. So with a 5% down payment, if you look it up on the CMHC website, so with a 5% down payment, a bank will require that your mortgage is insured in order to do that. And so in order to get that insurance, you pay that insurance as a buyer. You pay an insurance premium of 4% of the value of the property. And that gets added to your outstanding principal amount of the mortgage. So when you buy a property for $500,000 with 95% loan to value, that 4% gets added to it. So you're actually paying, $500,000 plus 4%. And then when you've taken possession of the property, you only put 5% in and 4% got added. So you now have only 1% equity in the property. And that doesn't include switching costs, which the switching costs of selling a property would be around 5%, I would say, probably, if you're accounting for a realtor, a lawyer, etc. And it also doesn't account for the land transfer tax that you paid on the way in, which is another sunk cost, plus the 5% fee that got baked into the value of the property. So, that's sort of how, if you buy with a 95% loan to value mortgage, you basically are entering a property in negative equity.
Wow. Okay. So don't do it. Would be my suggestion. But
it's a high risk. Like, I just want people to know that it's a high risk maneuver, and some people are willing to take those risks because they want to own a home, right?
Right.
Like, that type of mortgage is only allowed for owner occupiers who are going to be paying the mortgage with their own job. Like, yeah, I would say objectively it's pretty easy to say don't do it, but it's also hard to say that to somebody who, like, they've been renting for a really long time and they are so excited. They maybe had bad experiences with landlords and had to move around a lot, and they have a baby on the way, and like all they really want is secure housing, right? And so I agree, but it's also just sort of like understand the risks, right? And manage those risks. Yeah.
Yeah. So in that sense, the other thing I wanted you to maybe clarify on is maybe the costs that maybe we can get a sort of a breakdown on some of the costs that people miss. A lot of times where we only remember a lot of people who are not very familiar with this will only remember the down payment, maybe the closing costs, but there are some other costs that are associated with buying a property. I was hoping you could clarify those for us.
Yeah, I mean, I guess I briefly mentioned them when I was kind of explaining the discounted cash flow analysis scenario, but you have a lot of sunk costs when you own a property. So like they can be most easily described as TMI, taxes, maintenance, and insurance. Like that's what you'll often hear in commercial real estate. When you pay rent in commercial real estate, you'll pay a per square foot value plus TMI, taxes, maintenance, and insurance. And so like that would be your categories, right? So that you pay property tax, you pay maintenance. So like, fixing your roof or fixing your plumbing or whatever needs to be done. And then you pay have to pay insurance to insure that property against loss. And typically you need home insurance if you don't have, or if you have a mortgage, sorry, your lender will require that you have a insurance on the property.
Right. So, I mean, there's a big debate here, and you sort of mentioned a little bit about it earlier, where based on a certain profit margin, you can basically choose to invest in stocks and just the S&P 500 indices as against just like a real estate property. And I wonder what cases you would make for real estate over stock investing.
The big one is that most people, so if it's just over stocks, it's like it's easier to understand real estate than stocks. And so if it's just between I think that it's a decent criteria of something you should be investing in would be something that you understand. I think Warren Buffett kind of mentions that, right? Like, it's like a lot of people don't even know what these businesses really do. He doesn't invest in complicated companies. And so I don't know what 90% of these companies on the stock market do. Really, they're sophisticated businesses. And so, it would be hard for me to invest in, to really, really do the in-depth level of analysis that I would want to do to invest in one of them. Whereas it's not that hard for somebody to learn how to do that with real estate. So that would be probably the primary reason, is it's easier to understand. Secondary is you have control over it, right? So it's an asset that, you don't have control over the company and if they go in a bad direction, maybe it's too late. It's already been priced in and you're in trouble. Whereas with a house or, a commercial building or whatever, I mean, you can really determine where CapEx is spent, where OpEx is spent, how you can control your relationships with the tenants. And so I think I don't even really consider it an investment, to be honest with you. I consider it a bit running a business, but it's very much more like that. You have a degree of control over it, and you're one of the people who is on kind of the board that can decide what happens with the asset, if not the person, right? And so you have a greater degree of control over what you can do.
Right. So with that in mind, one of the advantages of stock investing is there's just a variety of things you can put your money into. And obviously, I know there are options in terms of investing in real estate. So I was hoping you could kind of lay that out for us, the different ways you can invest in real estate.
The different ways? Yeah, okay. So I mean, probably the most accessible way to explain to somebody who is in the in the mind of the stock market, it would be like REITs. So you can invest in REITs, which is basically a flow-through vehicle. So investing in a REIT allows the REIT to take out all of their expenses and then distribute returns to you as an investor, and then you pay tax on the income. So distribute income to you as an investor. Similar to like an LP, limited partnership, which would be kind of number two, would be you can invest as a GP or LP in a GP LP structure through friends and family, or through fundraising. So like offering memorandum or EMD, exempt market dealer. Those are kind of a couple of different types of exemptions. You hear EMD, it means exempt market dealer. So there's limited group of people who are able to sell like securities in real estate on I guess in more of a public market, but outside of like the stock market. And then like the final way, I guess crowdfunding is another good example, but then the final way is through direct investing. So just buying a property.
Right.
And that's kind of the one that I think most people really interpret when they're buying real estate, especially in Canada. Like most people want to buy directly. Yeah.
So I'm actually curious about the big leagues of real estate investment. Being a real estate firm, what is? I mean, maybe you can give me an example here. What is typically the strategy when a company or a group of people banded together as a broker, if you like, invest in real estate?
I mean, brokerages don't really do much investment work, to be honest with you. Like brokers transact the properties, but what you're describing, like more of a syndication deal, would take place in the exempt markets. So through like groups like EMDs, exempt market dealers, and they typically raise capital. So they create funds using OM exemptions or offering memorandums. And so an offering memorandum is basically like a complex document that explains everything that you would be getting from a risk to return perspective on a real estate investment. And that's typically when you hear, they're only reserved for accredited investors. You can typically only present those to accredited investors. And then those individuals would pool capital into a fund, and the fund would execute on the investment strategy outlined in the offering memorandum. So that's kind of like that probably would be the big leagues. Like when you hear Blackstone and, groups like that, those like large alternative asset managers, that's what they're doing. And in the US, it's incredibly common. Canada's crowdfunding laws or crowdfunding and exempt market laws are not as friendly to capitalism, I suppose. But the raising of like to that scale and type of real estate investment, to be honest. And so in Canada, our big leagues are really like institutional investors. So we have a lot of REITs, we have a lot of large capital markets groups, and then we have pensions. Like any office assets in Canada are owned by pension funds, really, right?
Right.
Whereas, in the US, it's not uncommon to see a large family office or a large syndicate owning office towers.
Yeah. And that's, as you kind of mentioned it there, that's the kind of real estate investment that most people, it takes a bit underneath. People don't realize that, a company like maybe Amazon has a landlord, maybe. If they don't own the land. So there's ways to invest in real estate in that way that is different to like a residential property,
Yeah, I mean, that's a good example, right? Because I think Prologis is Amazon's landlord, and there's a bunch of other large like REITs that you can get. If it's easy to get exposure to like AI compute as an example, right? Like NVIDIA is the obvious play, but nobody's thinking about the landlord that houses these these data centers, right? And it's not hard to get exposure to some of these markets in a safer way through investing in the real estate adjacent part of their business model.
Yeah. So along the lines, you kind of spoke about the differences between the U.S. Real estate system, and obviously the biggest one is the that I'm familiar with is the 30-year amortization. But I wonder some of the differences between the U.S. mortgage system and the Canadian system.
Yeah, I mean, the U.S. like we have amortizations that long in Canada, but they have a 30-year term. So if you got a mortgage in 2021 in the U.S. at 3%, you have a 3% interest rate. I don't know if they ever got that low in the U.S. I think 3.5%, but 3.5% interest rate. You got a 3.5% interest rate locked in for 30 years. So, it gives you an excellent degree of predictability on what you can do, for the next 30 years. Like you can literally make financial decisions modeled on the best interest rate that we've ever seen in our lifetimes for the next 30 years of your life.
Right.
In Canada, if you got an interest rate in 2021, it's up for renewal next year. And now you have to renew at a new rate, typically a 5-year term. We do have 10-year terms in Canada, but we only have a handful of mortgage terms in Canada. So,
right.
The Canadian mortgage market is very different, and a lot of it comes down to how our mortgages are funded. In the U.S., it's not hard for them to sell 30-year mortgage bonds or 30-year bonds in USD. It's harder to find people to line up to buy 30-year bonds in Canadian dollar because nobody it's less of a certain currency, right? Yeah. So that's one piece of it. The other piece is that I think the Bank Act regulates the length at which banks can fix terms for. But so the primary difference is that in the US you can lock in a mortgage rate for 30 years, and in Canada the longest you can do it I think is 10 years. I think there are some 15-year mortgage products, but 10 to 15 years. Again, even 15 at the longest is half the time. And so what that does is it creates a lot of volatility and interest rate risk in the Canadian market that's been that risk can be managed a lot easier in the US by taking a long-term mortgage term. And now this is only for residential credit that I'm referring to. In the US, a lot of your commercial loans are like 1 and 2 year terms, and a lot of them are coming up for renewal. And that's why we're seeing a lot of suffering taking place in the US market around offices and retail.
Right.
Yeah.
So, speaking of crises, I thought I'll start with the US kind of. I think it was in 2008. I'm not sure if my years are correct there, but there was a crash, and it was linked to kind of the way the mortgage system was structured, if I remember correctly, in the US. And I wonder what your assessment of the reasons why that crisis happened and sort of the lessons that we can learn in Canada from that.
Yeah, I mean, unfortunately, it seems like we haven't really learned a lesson because the the primary cause for the U.S., other than bad underwriting and probably I guess people taking on loans that they shouldn't have, funding deals that they shouldn't have, right? Ninja loans and stuff like that. They had a mortgage called an ARM, an adjustable rate mortgage, where those triggered later than a lot of these loans that were already delinquent, and the rate increased. And so in Canada, we're set up for the exact same thing to happen, right? Where we just saw a bunch of people take on rates in 21, 22 or 2021, 22 at record low rates. And in the next 2 years, they're all going to, 2/3, I think, of mortgages in Canada have to renew. And they're all going to have to renew at least a 50% increase in capital costs, if not like 100% increase in capital costs. And so this is going to have a huge, huge drain on our economy. Right?
Yeah.
And I think the outcome is going to look, I'm reluctant to say as bad as the global financial crisis, but I think the outcome is going to look pretty bad. Like there will be some very, very bad results of that taking place.
Right. Okay. So you kind of spoke about, like, briefly there about mortgage fraud.
Mm-hmm.
And that's a big thing that a lot of people don't realize is it happens. And I wanted you to kind of break that down for us. Yeah.
Yeah. I mean, mortgage fraud is exceptionally common in Canada. I would say like probably the most common type of it would be the mortgages that I mentioned earlier, those like 95% loan to value mortgages.
Yeah.
It's not uncommon for somebody who wants to invest in real estate to pretend that they're moving into a house and so they can get that access to high leverage and say, oh, I'm going to occupy this house. And then they just rent it out. That's not uncommon. So that's an example of mortgage fraud. Very simple, very common, not talked about at all. That would be a very, like, I think most people would call that an innocent example, although I don't think it is innocent, but I think most people would kind of shrug that one off.
Yeah.
Then there, then the next level would be document fraud. Document fraud is just where people are applying for a mortgage and they know they're not going to get the budget that they want from the bank, or they're not going to qualify for the amount that they want from the bank, and so they fake their income. They edit their job letter, right? They change their T4 or NOA or whatever. And because we don't have the verification mechanisms in place between the CRA and banks, they get away with it in a lot of cases. Or if they don't get away with it, it's not like they're being punished criminally. Like it's just kind of the bank's just like, we're going to put you on a blacklist and tell you not to come back here, right? And so these things don't really dissuade people from continuing to do it. And then, I mean, I don't, there would probably be maybe more severe versions of it, but I think that those are probably the two most common that are really worth mentioning.
Right. So speaking of the housing crisis that we currently have in Canada, what would you say are the major causes of the housing crisis? I have my ideas, but I was hoping you can shed some light.
I think mortgage fraud is a big one. I think money laundering is a big one. I think Yeah, I think money laundering, like Canadians competing with international money launderers for housing is big, and I think it's been indicated by the fact that three of our banks have been in trouble with FinTrack for money laundering, and one of them is at risk of getting in big trouble with the U.S. for that.
Yeah, I saw that.
Yeah, I think that's a huge component because that's a lot of capital, that's a lot of liquidity that's getting pumped into Canadian real estate and often housing. So that's a big one. I think record low interest rate environment for a sustained period of time is probably a big contributor. I think that era of like super low interest rates, it increased the buying power of the average person, and that just really boosted prices. And so that I think incomes haven't really caught up or kept up to prices. And I think probably our population growth being among the highest in the world doesn't help, right? Like, I mean, you've got the consumer of housing is people, and we have far more people moving to Canada than we do have houses, right? And so some sort of balancing of that would probably also help quite a bit.
Yeah. No, that's fair. And obviously, the government at the moment is there have been a few policies recently to try and counteract the housing crisis. So there's obviously the limits on short-term rentals that I saw in the news recently. There's also obviously the reduction in sort of immigration, which is the other tactic that the government is currently using. And I wonder how you assess these strategies and the potential success of those in tackling the housing crisis.
I think Airbnbs will do a little bit. I don't think they're going to do a ton, but making that an unviable investment will probably help bring some supply back to the market. I think they've estimated as high as 35,000 homes. So that'll do something. I think reducing immigration will do something as well. I think that I guess they're reducing international student population, which is a big demand source for
rentals, right? Yeah.
For sure, yeah. It really pushes your rents up, and that gradually pushes your price up. So I think both of those will probably do some of the work. I don't think it's going to do. I don't think anything alone is going to do all of the work. I think they need to get serious about money laundering. I think they need to get serious about mortgage fraud, which they're going to do. But those are a good start, I would say.
Yeah. So, in terms of the in terms of the actual creating more supply of the properties, some of the policies they've explored is sort of vertical construction and that kind of stuff. And I wonder how you see that strategy. Or some of the other structural related strategies that we can employ in terms of urban planning to improve our housing supply.
Yeah, I mean, density makes sense until you realize that it costs far more to build a high rise than it does to build a low rise on a per square foot basis. And so, like, while it's great to say, yeah, we can make all of these cities more dense, when that only works if people are lining up to buy these condos, as an example, and they're not anymore. They were, and now they're not. Pre-construction sales are down 75% from the long-term average. And so because it costs you, your total creation cost for a high-rise building is like $800 per square foot. Yeah. And so you had to sell it at $1,000 a foot or $1,400 a foot, depending on what your land cost was. And now all of a sudden, people can go buy a resale condo across the street for $800. Why would they? Right? Why would they pay more? And they realized this because they were buying. People were willing to pay the higher prices because prices were climbing. Prices aren't climbing anymore, and so that thesis is gone. And so now we've got a big problem where we don't have anybody funding these projects through pre-sales. Builders. The government wants builders to take the risk on their own by building these for purpose-built rental. So rather than converting these projects to purpose-built rental buildings, that only works with a handful of projects because their equity requirement is much higher. They have to hit the same debt service coverage ratio that we mentioned earlier in this episode.
Yeah.
Even with a CMHC mortgage, which CMHC also funds and provides mortgage insurance to purpose-built rental buildings, they would still require I think it's 40% increase above building code. So they have to be building like a very environmentally friendly building. So it ends up being more expensive, or they have to give a portion for affordability, or they have to build the building to be accessible.
Yeah.
So you're typically a more expensive building, and you can spread your amortization there off of over 40 or 50 years. So in that case, you get a 40 or 50 year amortization on that rental building. And in a lot of cases, the deals still don't work, even with a 50-year amortization, right? Which means that you're paying half the amount of principal that you would on a typical Canadian mortgage, 25-year amortization.
Yeah.
And it's getting some rental housing built, like a lot of it, I would say, but not enough to, hit the supply targets that we need. And a lot of it's not happening in the high-rise environment. It's happening in a mid-rise environment where the builders can build out of wood, right?
Right. So the other thing I thought I'd hit quickly is just like, in terms of the pre-construction, or the pre-buys, if you prefer. Why would I understand the concept in the sense that, a person buys or contributes to a project under construction and takes ownership when the project is done. But I mean, considering maybe some of the risks to that, why would a person choose to buy a pre-buy as against like sourcing a completed property?
Yeah, it's a great question. I think what is appearing to be the primary reason is because they couldn't afford to buy a resale property or a completed property.
Right.
So pre-construction properties typically have favorable deposit structures, so that would allow somebody to spread out the cost of buying a home over a year, 2 years, whatever. So you have 20% deposit, and you can pay 5% this year, or 5% in the next 6 months, and 5% in the 6 months after that, and and so they lowered the barrier to entry and functionally gave people a loan to come up with the money.
I see.
Yeah, and so I think there's some pretty clear selection bias that could happen as a result of that. But this is where we ended up with the situation where we're at, where like a lot of people can't afford to close these things and are trying to walk away from the deals, right?
Yeah. So just to tie this in now, there's obviously with the prices on housing right now, there is sort of a well-known despair amongst people my age that they're never going to be able to afford to get into the housing market and never going to be able to buy a property. The hope for some people was that during this high interest rate environment that housing prices would kind of like retrace a little bit. But my understanding is that hasn't been so. But even then, it's increasingly less likely that, people without like an insane cash flow are not going to be able to afford to buy housing these days. So I wonder how you speak to that. Yeah.
In what regard? Sorry, like if they're going to have a hard time buying a house today?
Yeah.
I think that there's really nothing wrong with renting. Like I think in Canada we kind of have this idea, like and there's like this culturally embedded thing that like we're supposed to own our houses. If you look at areas on Earth that are 100 years ahead of us, look at London in the UK as an example. London at the turn of the century had a greater population than it does today, or the same population that it does today, and their population actually fell after the wars. But in 100 years ago, everyone in the world wanted to move to London, and it was easier for them to do that because as easy as it is to come to Canada today, they didn't have airplanes, right? So people were migrating on rail or on foot, like on foot, I guess, with horses and carriages and whatever. Paris, London, etc. Everybody in the world wanted to live in that Western world, right? Now the same thing is taking place in the US and Canada and Australia. We will likely see the same thing take place that happened in those countries. What happened in the UK? Well, what's a flat, right? What's a flat in in the UK, a flat is a bunch of old row houses cut up into smaller apartments. That's likely what's going to happen in Canada. Is we can't build the supply. We're going to take existing supply and continue cutting it up until we have enough supply for to hopefully deal with this housing crisis. And so, yeah, that would be my thing, is like look at other countries in the Western world that Canada politically seems to be heading towards, and look at what happened there, and examine their home ownership rate, Paris, the UK, etc., and expect that as a result, and model your outcome based on that, and really run the numbers on whether or not it even makes sense for you to own a house. Like, it's really not that good of a deal, honestly. And I'm in real estate, so like, you know, you typically get realtors who are saying home ownership is the greatest thing on earth, right? Run the numbers. Most people haven't run the numbers.
But I'm actually curious about like so and that's exactly the point. Like the way you kind of said it there, where people don't kind of run the numbers. There's this assumption that we have to own a property. It's almost an obsession at this point, where, you know, so a lot of times if you kind of run the numbers, you find that it's maybe even cheaper to rent over the long term than it is to actually own a property, right? Anyways, so in this recently, obviously last year we had record levels of wildfires here in BC where I live, and I wonder how that influences, like, especially in those areas, because typically my understanding is that properties in those areas tend to be cheaper and that kind of stuff, which is why a lot of people move there. But how are like mortgages structured for people living in those kinds of areas where, you know, there's a propensity for certain disasters?
Yeah, it's interesting. I don't think it's something that we really modeled in on the mortgage side. I think it's just becoming a thing where we're really actually modeling in like climate sensitivity and thinking about building climate sensitive housing or you know, wildfire sensitive housing. The first time I heard about it a couple of days ago, 2 days ago at the Ontario Home Builders Association event, somebody from the federal government was talking to me about that. You know, in Florida is another good example, one of the hottest markets in the U.S., where, you know, the Gulf Coast is really, there's a lot of uninsurable areas, and you can't get mortgages on those properties because you can't get insurance. And so probably the big piece is an indirect way, where if the insurance becomes more expensive, you're paying more for the I part of your TMI, taxes, maintenance, and insurance, which means that your buying power gets reduced, right? So the values of those properties would be impacted because the insurance is taking up a bigger portion of the monthly payment.
In the being Canadian as you are, I was kind of wondering what changes, as we kind of come to the end here, what changes would you like to see in the Canadian system and in the policies that the government is currently making that will significantly move the needle in terms of real estate affordability and also availability?
Yeah, it's interesting. I think there's a big trade-off to be seen between like municipal governments and what they're charging for development charges. So like municipal governments charge development charges when a builder builds a property, and they make the most money. The municipal government probably collects more money than anybody else in the transaction, including the builder. But and that money's supposed to go for, they have this idea that growth pays for growth, is what you'll hear.
Yeah.
And that the development charges go to you paying for waters and sewers and parks and all of these different things. But most of these municipalities haven't spent all of those capital budgets, and they do have, you know, pipelines of things to spend that money on. But I would like to see some sort of reform in or cap in how much governments are able to pay or charge for development charges on a municipal basis, because it's become a trade-off where somebody's quality of life is either going to suffer as a result of the municipal expenses, like the parks and all that, or their unit, right? And we've obviously said, okay, well, they're suffering individually on a unit basis, and they get nice parks or good sewers or whatever. The challenge is like, I think that the private sector probably would be be able to do a better job at delivering the things that the municipalities are charging this money for. And so if we could privatize a portion of that, what those development charges go to, where, if you're a developer, you're responsible for servicing your own, like, and if you build a subdivision, you do this, you service your own lots, right? You service all of your own units. Is there room for that, for municipalities to kind of reshape the way that these utility projects are funded? I think so. I do. Yeah.
Right. Okay. Anyways, thank you so much for your time today, Dan. And as I said earlier, you all should go listen to some of the great work that Dan does on the Canadian Real Estate Investor Podcast. Yeah. So thank you for coming on the show, Dan.
My pleasure, man. Thanks a lot for having me.
Yeah. So you guys at home, thank you so much for listening. If you're not subscribed yet, subscribe down below. Thank you so much. See you on the next one. Thanks for listening to this episode of the Wolf of Young Street podcast. If you derive value from this podcast, please don't forget to subscribe. I would love to hear from you as well. So please comment your thoughts down below.